Welcome to this tax compliance class. My name's Kieran Doe. I'm a senior tutor at ACA Masters. When I sat the ACA exams myself, I won ICAEW prizes for financial accounting and reporting, tax, audit and assurance, financial management, business strategy, and case study, including the highest score in the world. I now teach the exam techniques and learning strategies behind the success to my students so that they can achieve similar levels of success. During this class, I'll be working through a full income tax question so I can show you how to deal with the main areas of income tax. This class is taken from the ACA Masters Tax Compliance video course. And the materials I will be referring to throughout the class are the ACA Masters Tax Compliance materials. Further details for the video course and materials can be found on the tax compliance page of the ACA Masters website. So when answering exam questions, I always look at the requirement first of all, so I know exactly what it is I need to do. And we can also look at the mark allocation as well, so we know how much time to spend on each requirement by multiplying the marks by our minutes per mark that we have available in the exam. So we can see the first requirement is to calculate the total income tax payable by Harvey for the tax year ended 5th of April 2023. Show your treatment of each item, ignore VAT. So we've got this for 25 marks. Calculate the income tax payable. Very standard TC question, because of course we know we've got the different types of income, and then we're going to come through and multiply through by the bands. So presumably there's going to be quite a lot of different types of income here because there's a lot of marks allocated to this part of the question. So then for the next part, we've got regarding Harvey's future plans, calculate Harvey's net disposable income, calculate and explain Harvey's marginal tax rate, assuming any additional income is from employment, calculate and explain Harvey's effective tax rate on his employment income, and then assume that rates and allowances continue. So straight away, I can see this bit here, we've got future plans, and this bit here is telling me, future plans. So the exam questions are tend to be laid out in a friendly way. So you can see that this part here relates to this part here. So you can probably ignore that part for now. I'm going to deal with these other areas first of all. And we can see we've kind of got quite a bit of information here. So just having a quick skim through to see roughly where things are. We've got something about employment here. So presumably he's going to be an employee. Then we've got other income and expenditure as well. So we've got some income and expenditure and some notes here as well to go with that. So quite a lot of information there. And then we've got future plans. So you can see why there's so many marks for this first part here. It looks as though this person's got quite a lot of different types of income that we're going to have to go through and deal with in the income tax computation. And then we've got this future plans bit here. So like I said, I'll ignore that bit for now. I'll deal with that when I come on to that part of the question. And as I also said, the examiners do tend to lay it out in quite a friendly way, and that's quite helpful that that bit's at the bottom, and that's the second part of the question, because quite simply, I'll just ignore that for now and then deal with it when I come on to it after. So then we can start reading through the scenario, and I read it in a really active way because I know what the requirements are. I know what I need to do. I know I'm doing the income tax computation. I know they're going to have some sort of employment income and probably some of these other types of income as well. So I've already started to think about what my answer is going to look like. Of course, it's an income tax computation, and you've done lots of these in the past. So we're going to have any working from employment income, and then we'll have to see what other types of income they've got. But because I know what the requirement is, and I've got a high level idea of how I'm going to approach the question, then as I read through it, I can put items in as I go and just constantly thinking about where this will be useful in the exam. So we're told how old the individual is, UK resident and domiciled. So that's quite helpful. So we didn't have to go and do like the residency test to decide whether they're resident or not. We're just told they're resident, and we're also told that they're domiciled in the UK. So that should make things fairly straightforward, in that if we know that they're resident and domiciled, we know they're going to be taxable in the UK on UK income. And if there is any overseas income, it will be taxable in the UK. But of course, there might be the possibility to claim double tax relief if it was also taxed overseas. But of course, we might not even have any overseas income. So we'll just have to wait and see what we're told in the question. But quite nice, they've told us this here, and we didn't have to decide for ourselves, are they resident, by going through the tests, or deciding, whether they are domiciled or not. So he has worked 2 days per week for Home Entertainment Limited, HEL, for several years. So, he's worked for a company, and this is presumably where he's an employee, and that's where the employment income's coming from. So he's told he also runs a hair salon as a sole trader. So he's going to have trading income, and owns a residential property near London, Hilling Road, which he has rented to tenants as a furnished let since 2019. So he's got a residential property which he's rented out to tenants. So this isn't like rent a room. It sounds as though he's got a whole property that he's renting out. So then we know he's also going to have trading income, because he's a sole trader, an unincorporated business owner, and also some property income as well. So we can start to see why there is going to be kind of quite a lot here. We'll probably need a working for each of these. So we can already start to see what his income tax computation is going to look like here. So Harvey records all his income and expenditure, other than that related to his employment with HEL, in a cloud-based accounting software package. Harvey does not elect to use the cash basis for his trading income, and nor does he claim fixed rate expenses. So of course, we know with the trading income, he could elect to use the cash basis if his income is below the required threshold, but he doesn't make that election. Of course, with property income, the cash basis is like automatic. So therefore, we will be using a cash basis there for the property income, unless we're told he elects to use the accruals basis. So of course, cash basis is that simplified method for small businesses. It makes it easy. If you think back to before you'd started learning accounting, cash is easy, isn't it? Cash that comes in, cash that goes out. But of course, we know with accounting, we're using accruals basis, and we know we're using the accruals basis there for the trading income. And he doesn't want to claim the fixed rate expenses. So again, that's going to be useful for the trading income when we're thinking about that. But we're told about the employment income first of all, so I'm not even going to worry too much. I'd probably just make a note here, doesn't claim fixed rate expenses, does not elect to use the cash basis. So I'll just remember that when I come back to the trading income. So then we get onto the employment part. So we know he's an employee, and we're told remuneration package comprises. So this is typical for an employment income type question, or part of a question, in that we're told that somebody's an employee. We're going to be thinking, what is it they receive from their employer? Because of course we know they're going to pay income tax on the cash and also the benefits that they receive from their employer. Of course, national insurance is only paid on the cash by the employee, and the employer pays national insurance on both the cash and the benefits. So of course, what we're going to need to think about is, what cash and benefits is he receiving from his employer? And then we need to think, are they taxable or not? And these questions are always very similar. And what we need to do is we just need to think back to our rules. Is it taxable or is it exempt? So of course, with benefits, they tend to be the trickier one. I mean, there can be some complicated elements of cash, but it's generally taxable. But with benefits, we know, of course, that some benefits are exempt, and therefore they won't be taxable at all. But they tend to be small benefits and socially beneficial ones, like pension contributions or like cycle to work schemes. So then we know other benefits are taxable. Now, the default position is that the amount that's taxable on the employee is the cost to the employer. However, some benefits have very specific calculations, accommodation, cars, vans, loans, and assets. They all have very specific calculations that we needed to have learned, and as we covered in the employment income class. But other than that, the default position is the cost to the employer. So there's a lot of rule learning that we had to do here. Now, of course, if the employee themselves have paid amounts out relating to their employment, so they've got an expense, there's very few that are actually allowed to be deducted for income tax. So that's what we're usually told in these questions, as we've seen before, and as you should be doing, practicing lots of questions one after the other on employment income, and you'll soon see like the questions tend to be in a similar way. And really all you need to have done is kind of learn how each of these are taxed. So we usually get a mixture. We usually get, some cash amount, maybe 1 or 2 cash amounts, a couple of benefits which are taxable, a couple of benefits which are exempt, and we might get a deduction as well. So let's have a look here. So salary of 30,000, the nice easy one, of course, salary we know is going to be taxable because that's cash. But we're told here, however, under the company's optional remuneration arrangements, Harvey has reduced his salary by £300 to this. So he's reduced his salary by £300 to be provided with a private gym membership by HEL. So he gets a salary of 30,000. At his employer, they've run this optional remuneration arrangement, and what he's clearly agreed to do with his employer is give up £300 of his salary, and instead his employer is going to provide him with a private gym membership. So maybe they've paid for him to have a membership at David Lloyd, Virgin Active, etc. So the gym membership costs the employer £360 per annum, and the normal membership price is £420 per annum. So we've got quite a few different amounts here. So we know that his salary is now only this. So his salary has reduced. So we have his salary. So when we're going to calculate the employment income, we know what the salary amount is, so we can put that in there. That's quite straightforward. But what we need to do is decide how this is taxed. So of course, we know that a gym membership, a private gym membership provided by the employer, and they paid a gym membership fee on his behalf, would be a taxable benefit. And when it's taxable, it's going to be the cost of the employer. There's no specific rule here like there is with cars accommodation. So the default position, cost of the employer, £360, not what the normal membership price is. It's the cost to the employer. And you can see in this case, they're not the same. And there's other examples which we went through in the employment class when of course they wouldn't be the same. So we know that that's, if they give him that benefit, that's what's usually taxable. And now there's some very particular rules here around salary sacrifice, because in the past, what a lot of employers had done is had arrangements where the employee gives up salary and therefore pays less tax because they've got a lower salary amount, and then give them benefits which are exempt. So therefore they reduce the salary, no tax or national insurance either, and then give them benefits which are exempt, so no tax on the benefit either. So there are specific rules here when it's salary sacrifice, and we'll take the higher of the benefit amount, which we've already worked out, and the cash sacrificed. So of course, so we've got the optional remuneration, or you could just put the gym. So we've got the optional remuneration arrangement, and then we're thinking here, how's it taxed? Well, of course, as we said, you can just put the two numbers here so the examiner's clear on what we've done. And the salary given up, so the salary like foregone was £300, and the amount that would be taxed as a benefit would of course be the 360, the cost of the employer, and we take the higher of the two, so it would be this. Of course, if this was a benefit which was exempt, maybe like a mobile phone or something like that, then you can see, the salary would be the higher of the two, so that would be taxed. Even though the benefit's exempt, they would still be taxed on the salary sacrificed. So a bit of a tricky one there actually to kick us off, but you usually get a mixture of easy, medium, and hard ones. So then we've got the next one. We've got a car with a list price of this. So car's got a specific calculation. So we're told car's got a list price of this, which costs the employer this. So first of all, it's important to pick out we're dealing with a car here. So there are some very particular calculations, but these are with cars. Note it doesn't say vehicles. So therefore, there's less, vans are taxed, less than that. So we've got a car. So it's cars where these very specific rules apply, and it's cars which are heavily taxed. So we've got a list price of this and it costs this. So yes, I said the default position is the cost of the employer, but this is an area where there's a specific calculation. So for the car, got a very specific calculation and we take the list price. So it's important that we get the list price first of all. So make sure it's definitely a car. Don't just assume or don't think it's like all vehicles. So we've got the car, so we've got the list price, and it's not, you know, the cost of the employer. And you'd include any like optional extras that are included in the car as well. So we've got the car, this is the list price. Now the employee contributed 6,700 towards the capital cost of the car. So we know to calculate the benefit of a car, we're going to take the list price and multiply it by the relevant percentage, and that's going to be the taxable benefit. But with any of these benefits, if the employee contributes to the benefit, then obviously that reduces the amount of the benefit, because it's kind of like the employer's giving the employee something, but if they're giving them like a little bit back, then of course you're almost taking kind of like the net that the employer gave the employee. So if the employer gives them something which has got, you know, a value of 600, but they pay, you know, 400 to the employer, then what the employee is receiving is 200, of course. Just think of that kind of logically. So yes, they've given them a car which has got like a list price, so a tax value, if you like, of this, but the employee is paying towards it. So therefore, you know, what the employer is giving the employee is effectively like the net of the two. Now with a car, however, there's a very particular rule that the employee capital contribution is capped at 5K. Very particular, specific rule, that quite not too tricky to remember. I think once you've seen it once or twice, but it is quite a particular rule. So that's definitely something to look out for there. So we've got the employee contribution, which would reduce the list price there. So we're told that Harvey paid for all diesel costs. Now this sentence actually tells us two things. One, it tells us that the employer, whilst they give Harvey the car, they don't also pay for his fuel, because Harvey pays for all fuel costs. If they paid for his fuel, that would be another benefit. So it'd be a benefit on the car and then another taxable benefit on the fuel. But we're being told that Harvey pays for the fuel. Now we're also being told that the car is a diesel in that same sentence. And that would affect the percentage that we're going to use. So when we look it up in Hardman's, that would affect the percentage that you're going to use, because it's based on the CO2 emissions, and then there's an additional amount if it is a diesel car. So again, kind of telling us two things there. Now, fortunately, we don't have to go and calculate the percentage for this one, because it says the relevant benefit percentage based on the CO2 emissions is this. But of course, you could just look it up. You know, if you're told the CO2 emissions and you know it's a diesel, you can work out what the relative percentage is. But it's been quite nice in this question, in that it's just given us the percentage. So we'd multiply that by this amount, and therefore we've got the taxable benefit on the car. So we're not worrying about national insurance here. So even though we may have to think about it later, that net disposable calculation, you could have like a cash at the top and benefits at the bottom. That's something I quite like to do sometimes, just so if I do have to work out the national insurance, I know that employee national insurance on the cash and employers, but that's class 1 primary and secondary. And then the benefits, whilst the employee pays income tax on the benefits, they don't pay national insurance on it. The employer pays class 1A. So it can be useful to do that, to split it up between the cash and the benefits. It's an important thing to appreciate that employees don't pay national insurance on benefits, whilst they do on cash. So then that's the car dealt with. Then we can come on to the next one. So a general lump sum allowance of £250. Harvey spent £190 entertaining HEL clients. So he's received a general lump sum allowance. That's just taxable. Okay, it's just a general lump sum. It's just additional cash. Think of it as like an additional part to his salary. That's going to be taxable. That's quite straightforward. Lump sum, £250. Now the entertainment costs. So that's what Harvey's paid out. So he's received £250 from his employer, and he's then paid out £250. So we're thinking, Harvey's paid money out. Can he deduct that as an expense? Well, entertaining costs, aren't an allowable expense. There's very few things that can be deducted from employment income, and the main ones for the purposes of the TC exam being travel to clients or suppliers, mileage payments if for work travel but not home to work travel, and if they haven't been reimbursed by the employer, professional subscriptions and pension contributions. So that expense isn't deductible, so we should kind of make that clear. We could have this here, entertainment, paid, not deductible or not allowable. We could even just put, to be really quick in the exam, you could just put, maybe even disallowable, like that. Now, if instead though, they had given him an entertaining allowance, if this wasn't called lump sum allowance, if this was called entertaining allowance, then he would only be taxed on the net amount. So really all he's ended up with is £60. But because this is a lump sum allowance rather than an entertaining allowance, it's tax on the full amount, can't deduct the entertaining. If that was called entertaining allowance, then he'd only be taxed on the 60. So that's a tricky thing to look out for. And if instead of giving him £250, they just reimbursed him the £190, then nothing would be taxable, nothing would be deductible because he spent £190, they gave him £190. That's a very fiddly rule that around those entertaining allowances, so look out carefully for the wording in the question. So then the next one we've got is use of video gaming equipment owned by HEL from the 5th of November 22. So it seems as though all of these, he's been working there for several years. Presumably these are all for the full year amounts. We're not told about any months here, but here we've clearly got some prorating, and that's always something to look out for in the exam. So they've given him video gaming equipment. So just the use of it, they haven't actually given him video gaming equipment, use of video gaming equipment, which is owned by the company. So the company's got an asset which is given to him for private use. The equipment cost HEL 620 and had a market value of 840. So private use assets, we do 20% times the market value or the rent if that's higher. So market value of 840, we're going to take 20%, but of course we've got some prorating. So for the tax year 22-23, obviously conveniently it's been given to him on the 5th of November. So he's been able to use it for November, December, January, February, and March. So therefore 5 months in total. So therefore we've got the private use asset. So we can have a working here. You can see it's really important you have all your workings and make it clear. You can use shorthand like this, list price and EE for employee and things like that, as long as it's clear to the examiner what you've done. But it's important because if you make a small mistake in the calculation, then the examiner can kind of see what you've done and still give you credit. So we were told that the market value, that was 840 for the gaming equipment. We know that the annual benefits, you could do it either way. You could do it for take the 20%, and then we would take the 5 months. So we know per year he would be taxed on this amount, and then we would divide by 12 and times by 5. So then we've got the private use asset here. So again, that's another particular rule there that we've got for private use assets. We've got the 20%. And then we're told HEL and Harvey each make pension contributions to the HEL workplace pension scheme at an amount equal to 2% of Harvey's salary. So the employer and Harvey himself, the employee, they each make pension contributions to the workplace pension at 2% of Harvey's salary. So you can first of all think about how this works with a pension. So as we covered in the pensions class, there's broadly 2 types of pension, like a workplace pension or a personal pension. But the way a pension scheme works is the same. Contributions are made during the individual's working life. So they make contributions to their pension fund. This will invest in stocks, shares, bonds, all sorts of different types of financial assets. then there will be returns on those assets, and all those returns will be tax-free. So it's really generous treatment of pensions. So all of these amounts are built up tax-free. So the shares, the bonds, possibly even property, other assets they might own in here, gold, for example, even some cash assets. So all of these will build up tax-free, and then when they get to retirement age, they will then take their pension income. They can take a lump sum tax-free, and then the rest will be taken as pension income. So that's how the pension works. So the government obviously wants to incentivize people to save for their retirement, and therefore there's generous tax relief. As I said, the assets build up in a pension tax-free. When the individual gets to retirement age, they can take 25% tax-free, and the rest is taxed as pension income, as non-savings income in the income tax computation. So there's also generous tax relief when the individual contributes to their pension. So we can see here, you've got the individual contributing to the pension. So if it's a workplace pension, the way the individual gets relief for the contributions they make is by deducting it from their employment income. So Harvey's made contributions to his pension. We can work out the amount that he's contributed because we were told in the question that it was 2%. So it's 2% of his employment income. So, 2% of his salary. So we've got, it contributes 2% of his salary to the pension. So therefore he's contributed this in the year, and that gets deducted from his employment income. So less of his income is going to be subject to tax. So that's how he's getting tax relief. Without that contribution, his employment income would have been higher, and therefore he'd end up paying more tax. So by having that pension contribution in there, that reduces his employment income, and that's how he saves tax at his highest rate. When we go through and we multiply through all of the bands, he's now got less employment income in there, so it ends up paying less tax. Now, we've also got the employer contribution. And as we said, whenever the employer gives the employee something, we're always thinking, is it taxable? So we're always thinking, is it an exempt benefit? If so, great. If not, it's taxable, default cost of the employer, or a specific calculation. But of course, as we've said, generous tax relief available for pensions, and therefore, unsurprisingly, this is an exempt benefit. So when the employer contributes to the individual's pension, then that is an exempt benefit. So it's a benefit still, but it's an exempt one. So you could put pension exempt. And maybe we should just be clear, you could put employer contribution exempt. So, quite generous treatment there with pensions, as you'd expect. And that's how the occupational pension work. Employer puts money in, exempt benefit. Individual puts money in, you deduct it from the employment income, and then they're saving tax at their highest rate. So deducting it from the non-savings income, and therefore they're going to save tax at their highest rate. So of course, there are very generous reliefs for pensions, and as we discussed in the pensions class, of course, there is a cap to how much an individual can put in each year. So then we are told that the employer deducted income tax of this via PAYE. Now, of course, we know that's how it works for employees. The employer pays them their salary, but the employer withholds the tax. So they withhold the tax, and then the employer pays the tax over to HMRC. That's why if you're just an employee, you don't need to fill in a tax return, because your employer will pay you your income, but they would have already deducted all of the tax. When we go through and multiply by the bands, we'll see that the tax already deducted, via PAYE will be the tax liability on that employment income. And we can see it was 5459. So, assuming that they have coded it correctly, then that should equal the income tax liability on the employment income. So that's just a tax that the employee has been taken off the employee at each and every payday. So the employment income parts aren't too difficult to deal with. We cover this in the specific employment income class. And if you go through and practice several questions one after the other, you'll soon see it does get kind of quite repetitive. And really, it's very knowledge-based as well. So, what you need to do is memorize these key rules. So one way I suggest doing that is make sure you've kind of understood what all of the amounts represent, and then understand the tax treatment. So the individual tax treatment in terms of how to do the calculations, but also the big picture as well. Remember, cash, employee pays income tax and national insurance. Employer also pays national insurance, but the benefits, the employee only pays income tax. Employer still pays national insurance, but it's class 1A. That's an important thing to pick out. A lot of people don't realize, or they fail to appreciate, that employees don't pay national insurance on their benefits, only on the cash. Employer pays national insurance on both. So that's kind of like the big picture. And then cash, relatively straightforward. Things like mileage payments, you obviously need to appreciate how they work. The excess over and above the statutory rate is, of course, additional cash that the employee is receiving. But then with the benefits, learn the exempt list. And again, look at the big picture. It tends to be trivial, small amounts, or things which are kind of socially beneficial, like childcare facilities and work-related training. None of the fun stuff, basically, like the cars, the speed boats and the hot tubs, things like that. And of course, the faster the car, or the more polluting the car, the higher the tax on that. Accommodation as well. Again, heavily taxed. So specific calculations there. Default is the cost of the employer. And if the employee has got expenses that they're paying out related to the employment, if it is, wholly, exclusively, and necessarily for their employment, then yes, it can be deducted, but some specific rules around, travel. So home to work travel not included, unless they're site-based or like a working from home employee. And then things like professional subscriptions, again, that's something that the employee would have to incur in order to do their job. So think about your ICAEW subscription, for example. If you had to pay that yourself, if your employer reimburses you, and then of course, there's nothing for you to deduct because you've received an amount for that, and therefore there's no expense. If the employer gives you the £500 and then you pay the £500 out, there's no net income there for the employee, so therefore wouldn't be taxable on that reimbursed expense. So then once you've done that and you've understood how each of the different amounts are calculated, then I suggest testing yourself by turning over, pulling up a blank page and see if you can reproduce them all. So how it's calculated, is it taxable, is it exempt, and then what are the national insurance implications of that benefit as well. And then just go away and practice several questions one after the other on employment income. And you'll start to, that's a great way to kind of test yourself, because you're actively testing yourself. Even when you pull up a blank page and reproduce it, you're actively testing yourself. You're forcing your brain to recall that information rather than just passively reading. And then even better, when you start practicing questions, again, you're doing that active recall, forcing your brain to recall that information. But it's even better because you're doing it in an exam scenario. So you're doing it in a specific scenario, you're going to be tested on it and where you need to perform. And as well as being able to work on your exam technique and test yourself in an exam scenario, you'll start to see the little ways that the examiners word things and some of the little things which can be in there that may trip you up. So we're then told about other income and expenditure. So we're told that Harvey has provided the following information, including figures downloaded from the cloud-based accounting software package. So we were told up here that he records all his income and expenditure other than that related to his employment in a cloud-based accounting software package. So we know that he's an employee, but he's also got his own business. He runs unincorporated business, a sole trader. He's got residential property. So we'd expect to see the amount from his business, from the hair salon, and also rent from the residential property in here as well. And we've got the breakdown from that here. So income and expenditure for the year, and it's nicely kind of laid out here, income and expenditure. So we've got sales in a hair salon. So might have a quick skim through this. So sales from the hair salon, interest on a bank account, rent received from the tenants, and we've got the notes here as well. So about the rent, dividends received in an ISA, and then we've got the expenses. So salary paid to the salon manager, national insurance, bills, hair products, supplier entertainment. So most of these seem to be to do with the business, and then we've got some to do with the property income as well. So we know that he's going to have trading income, and we know that he's going to have property income as well, as we've already discussed. So the trading income will almost always be more involved. There's more to do with the trading income. Property is relatively straightforward. So of course, with the trading income, what we're going to need to decide is which of these expenses are allowable and which of these expenses are disallowable. So of course, we know that unincorporated business owner, so he's a sole trader, it's not a partnership, it's just him. So he owns the assets personally, and we know that he's going to pay income tax on that trading income, as we've seen, of course, in the income tax computation. That's a line in the income tax computation for sole traders and partners. So we know that he's going to pay income tax on the trading profits. He'll also pay class 2 and class 4 national insurance as well. And you could potentially pay class 1 as an employer this time. So he could be an employer as well, could be employing people to work in the salon. And the fact that there's a salon manager seems to suggest that he is. So he's a business owner in this case. So what we're going to need to do to calculate that trading income is decide which expenses are allowable and which expenses are disallowable. So there's kind of two ways we can do this calculation, really, because we could start with like the net income, which presumably if you've got these expenses minus off the expenditure, this is the net amount of the income. So you could start off by having everything included and then taking out the amounts which don't relate to the business or aren't allowable expenses. So that would be kind of one way to do it, and might be the way that you've seen in most questions. So that'd be one way to go about it. We could start with the net income amount, and that includes everything. As we saw, that's just a sum of all of the amounts above. So we could start off with that, and then so it's the 50,800, and then take out like the income which is like non-taxable or taxed elsewhere, and then add back the disallowable expenditure. So non-taxable / or taxed elsewhere. So things like the interest income. Obviously, what we're doing here is we're starting off with everything included. So if it isn't an allowable expense, you have to add it back. Or if it isn't taxable, you need to deduct it. Alternatively, what we could do here is you could just have the income, which should be included, and the expenses, which are allowable. So you could start with everything included, take out the non-taxable amounts and disallow expenditure, which isn't allowable, or just include the income, which is taxable, and therefore not including the income, which isn't taxable or is taxed elsewhere, and only including the expenses, which are allowable. You'll get to the same answer. Now, I'd probably say, the more common way you'll see it is probably adding back the disallowable expenses, but we'll do it both ways just so I can kind of show you both. So we've got like income, so sales in a hair salon. So obviously that comes under trading income. It's a hair salon. That's obviously the revenue there. So if we're calculating the trading income, then of course you just have the income which is from sales, basically revenue. So you've got 95360. So of course if we've already started with the net income, that obviously includes that number because that's the total, and therefore that number is correctly included in there because that's taxed as part of the trading income. So if we're we're trying to get down here, aren't we, to the trading income, and therefore that figure's included in there and it should be included in there, so that's why we would include it. Obviously if we're kind of starting off with 0 here, so therefore we'd include that in the trading income. So then we've got interest from the business bank account. So if an individual receives interest, that is taxed as interest and therefore needs to be included in their savings income. So if we look at the amount here, £214. So of course that needs to go up here. So we've got non-savings income, savings income, and that should be in here, interest of £14. Now, so if we're calculating our trading income, from scratch, then we don't include it. We only want to include the trading income from the business. We've just included this number. We wouldn't include this one here. We don't need to show it. We've shown the examiner. We know it goes in under interest here. Now, of course, if we've instead started off with taking the total figure, and that of course includes that, then you would need to take it out. So then we would need to take out interest income. So like I said, it depends with what you're starting with. And it's really important to read the question to see if the amounts have all been included or not. So then we've got the next one. So income, this is rent from the tenants, 18,200. We've got a note. Rent of this is due on the 1st of each month. So monthly rent of 1,400 due on the 1st of each month. Tenants paid the rent due at the end of the previous tax year, at the start of the current tax year. All subsequent rent payments were made on time. So we know, of course, with property income, they'll be using the cash basis. He'll be using a cash basis, unless he's kind of elected for a different basis, which we're not told he has. So the cash basis applies automatically. So actually we know, but of course we're going to have property income here as well. So you might want to kind of do this at the same time, because we're going to take it out of trading and put it into here. So of course we know that the rent, if we just with 1,400 a month, you'd expect it to be per year this amount, but we know they paid a month late, and that explains that extra 1,400 there, because you can see that's that extra month there. So that's what they received in the current year, because this was due at the end of the previous tax year. They received this on the 10th of April, and then would have received all of the other rent on the 1st of each month. So from May 22 to April 23, inclusive, that's your 12 months there, plus this one is the 13 months. And we're taxing this on a cash basis. Of course, if you use an accruals basis, you'd only record 12 months of income every year, because that's the period that the income relates to. The annual rent per year is as we've just worked out here. So on an accruals basis, it should be this. It would just be like accrued income or deferred income, at the year end in theory. But we're using the cash basis. So this is the amount of cash received. So that's what's going to be taxable as property income. So of course, we don't want to include this in the trading income. So if we're just calculating our trading income by just starting with nothing and then adding in all the trading amounts, of course, we wouldn't include this. If we've done the other way, where we started with the net income, then we would need to take out the property income, of course, because we're taxing it elsewhere. So it needs to be, if we're calculating our trading income by starting with the net income, including everything in it, we need to take this out. So then we've got dividends received from shares held in an ISA. Again, this doesn't relate to the hair salon business. So if we're using this method, you'd need to take the dividend income out, and the dividend income 1270, and then that is taxed as dividend income. But of course, because it's in an ISA, it's exempt. So you could put, ISA exempt there. So you could just put divs here. Now, of course, if we've used the other method and we're just we started off with nothing, of course, the dividend income isn't included here. So hopefully you're kind of starting to see how the two methods work. Same, we've got expenditure, salary paid to a salon manager. Well, that's definitely, an allowable expense when calculating the trade income. So the general rule of what's an allowable expense, what isn't an allowable expense, the general rule, if it's for business purposes, then it's an allowable expense. That's a general rule. If it's entirely for business purposes, so not for the owner's personal private use, if it's for business purposes, then it is an allowable expense. However, there are some rules, once again, which have specific rules. So, third party entertaining is disallowable. Specific rules about general provisions, only deductible when they are paid. Even wages have to be paid within 9 months of the year end. fines are disallowable, capital related fees, so like legal fees related to capital items. Leased cars have a specific rule around them as well. And of course, with tangible assets, then disallowed the accounting amount, so depreciation, loss on disposal, and instead claim capital allowances. So, salary paid to a salon manager, yes, provided it's paid within 9 months of the year end, and we're not told it isn't, and I don't think many people would be waiting 9 months after the year end for their wages, so therefore assume that it has been paid. So of course, if we started off with this amount, which is already deducted it, then it's allowable, so we don't do anything. But of course, if we're using this method here, then and we're just including all of the allowable expenses, then we would need to deduct it. So this is quite a good way to do it like this. Obviously, you wouldn't do it like this in the exam. You choose one way and go with it. But obviously, when you go through and practice lots of questions, you'll see, sometimes they'll say, these expenses have been included in calculating this. So therefore, if you were going to disallow them, you'd add them back. But then other questions say this is before including or before considering the following expenditure. So therefore, if it's disallowable, you do nothing. And if it's allowable, you add it back. So it's really important you kind of think about whether it's been included or not. And you'll see that in the questions as you go through and practice them. So then national insurance. So we've got a note here. So Harvey paid the following national insurance contributions during the year. So class 1 secondary and class 1A. So of course we know that in this context, Harvey's a sole trader, he's the employer. So Harvey's employee, salon manager, we don't know if there's any others, and he'll end up paying class 1 on any cash and benefits provided to employees. As we said, employers pay national insurance on the cash and the benefits they give to their employees. So if he's paid class 1 secondary, that would be on the wages that he paid, the cash amount to the salon manager. And in class 1A, he must have also given us some benefits as well, him or her, in terms of the salon manager. They must have also given them some benefits as well. So these are business expenses because, just like paying the wages is a business expense, paying the national insurance on those wages is a business expense. It's like payroll taxes. So therefore, that is an allowable expense. Paying the wages, having the salon manager is entirely for business purposes. So therefore, the class 1 and the class 1A will be allowable expenses. So the class 2 and the class 4 national insurance, this is the national insurance that Harvey pays. It's his personal tax liability on the profits. So as we've said, on the profits of the business, the trading profits, Harvey is going to pay income tax, but he's also going to pay class 2 and class 4 national insurance. So this isn't an expense of the business. This is like Harvey's personal expense. That's his personal tax liability. So hopefully you can see the difference between the two there, between the different types of national insurance that he's paying. So of course we said, an allowable expense is the, NI 1 and the 1A. So we can work out what those two amounts were because the payroll taxes, the national insurance related to employing the salon manager. And we're told the amounts there are 1150. You might just even in the exam just want to have a quick working for that just to make sure you get it right. But even if you did make a small mistake like 1510, it could be a typo. The examiner should be able to see what you've done. But just to be clear, you might want to just have 1 and 1A and then just add them together. So they're the allowable amounts. So if we're starting with what's taxable minus what's allowable to get to the trading income, they're the amounts which you are allowed to deduct. If we've started off by deducting anything, then fine to leave the 1 and the 1A in there, but we'd need to add back the class 2 and the class 4 because that's his personal tax liability. And we're told that the class 2 and the class 4, so we've got the total for the class 2 and the class 4 is going to be 3464. So we've got the 3464. So these were already deducted in arriving at its net income. So it's disallowable expenditure. So therefore we need to add it back. And I think I said we would have those expenses down there. So that's the disallowable amount there. For the national insurance, that's the national insurance dealt with. Then we've got utility bills. Again, that's definitely an allowable expense. There's no rule why that would be disallowable. That's purely for business purposes. No private use for the owner. It's not capital in nature. It's not a leased car. So that's definitely allowable. So 6,800. So that would be deductible here under this basis. Utilities. So if we hadn't included it, then that would need to be included. If it's already been deducted, fine, leave it because it's allowable. Hair products, same again, that's an allowable expense. So if it hasn't already been deducted, then deduct it. If it has been deducted, fine, that's allowable. So supplier entertainment, so that's third-party entertainment because the supplier is a third party, not somebody in the business. So not like staff, for example, and therefore that is disallowable. So therefore, if we haven't deducted it, don't do anything because you're not allowed to deduct it. It's not allowable. If you've already deducted it because you're starting with the net income, the net profit, then we'd need to disallow that. So you could even just put, third party entertaining. Now, examiner will know exactly what that is. They're all qualified tax professionals, and you've also got the number there as well. So legal fees, got a note here, legal advice on new health and safety regulations. So again, with legal fees, you have to think, is it capital related? So is it to do with like buying a new asset or taking out a lease, although a renewal of a short lease is allowable? But is it taking out a new lease or renewing a long lease, or is it buying like a new property? If so, it's capital related because it relates to like an asset and therefore disallow it. But this isn't. This is health and safety regulations, which presumably is entirely relevant to the hair salon business. That obviously need to comply with that, and they've obviously needed to take some legal advice on that. So that would be an allowable expense. So because it's already been deducted, if we were using the other method, do nothing. Van. So we've got a note here. So like I said earlier, van, not car. So this is a van. So that, cars are taxed really heavily, as I've said. So an employee who's given a car by the employer, the taxable benefit is high, particularly compared to a van. The taxable benefit will be high. So cars are taxed heavily when an employee gets private use of a car. When businesses buy cars, whether unincorporated businesses or companies, if they buy a car, then it will go in the capital allowance pools based on the CO2 emissions, but of course can't claim AIA on cars. So again, you can see cars getting unfavorable treatment, can't claim AIA on cars. And if the CO2 emissions are high, they'll end up in a special rate pool where you don't get very many allowances. So again, cars have very unfavorable treatment. And if rather than buying a car, they lease a car, we know, of course, some of the rentals will be disallowed if they're above a certain threshold. And again, it's cars, not vans. So it's cars that have this really unfavorable tax treatment, whether it's a business buying a car or whether it's an employee getting private use of a car. Cars have really unfavorable tax treatment, but vans don't. I mean, they're not completely tax-free, but of course, when an employee receives a van, it's taxed at a lower amount. When a business buys a van, they still can claim AIA on it. If they lease a van, there's no restriction based on the CO2 emissions. So like I said, with the employee benefit, focus on a vehicle. It's not, this time it's a van rather than a car. So purchased it in January 23, so not for the full year, so that the salon manager could collect large volumes of products from the supplier. So it sounds like they've bought the van for business purposes, and therefore it sounds like a private use, might not be any. The van has CO2 emissions of this, but we're not concerned about, that's for cars where we always need to know the CO2 emissions. So where we're going to focus more on the CO2 emissions. So they often include this to kind of sometimes throw us off a bit, or make sure you know the difference between vans and cars, the tax treatment of them. So during the 3 months to the end of the tax year, a total of 180 miles were travelled in the van. Harvey used the van for a private purpose for 3 days in February when his car was being repaired, traveling a total of 18 miles. So there has been some private use by the business owner. Harvey's bought the van. He's a business owner. It's an unincorporated business, so he owns all the assets personally. That's what an unincorporated business is. He's bought the van, but only 90%, because 10% is for private use. Obviously, you could work that out, but quite obvious there with the numbers. Only 90% is for business use, 10% for private use. Now, we're told the salon manager traveled 70 miles in the van for private purposes. All other use was for business purposes. So it's very important here you focus on what private use has there been. So it's Harvey that owns the van, and he's used it 10% for private purposes. So now there's the other 90%. So the other 90% has all been for business purposes. Now there's this issue of the salon manager. Now, even though she's used it for private purposes, we're calculating the trading income for Harvey's business. And even if the salon manager has been using it for private use, from Harvey's point of view and from the business's point of view, that is still for business use. Because if an employer gives an employee an asset that they can use for their private use, and clearly he's obviously permitted use of the van for private use, then that's part of the remuneration package of the employee. So therefore, it will be the employee, the salon manager, who will pay income tax on that benefit, the fact that she got private use of a van. But from Harvey's point of view, and from the business's point of view, even though the salon managers use it for private use, that's still business use. So if you own assets and you've given them to your employees for private use, that's effectively part of their remuneration. So that's very similar, if you like, to the wages and salaries. He paid the salon manager cash, and as one of her benefits, she can use a van for private use. But from the business's point of view, that's all a business expense, because you're just paying your salon manager some cash, and you're paying your salon manager effectively a benefit, saying, look, use one of our assets for private use. And therefore, you only need to restrict private use when it's the business owner using it themselves. And that's why when we look at corporation tax, and when we come on to the corporation tax class, there'll never be a private use restriction for an asset, because the company, the business owner, can't use an asset because a company isn't a physical, natural person. So therefore, with the van, so we've got the cost of the van here. So purchase the van, so this isn't just a lease, purchase the van for this amount. So of course, when when businesses purchase assets, this is an unincorporated business, not a company. When businesses purchase assets, we're thinking, what capital allowances can be claimed? So of course, AIA can be claimed because it's not a car. If it was a car, you can't claim AIA. But it's not a car, it's a van, and therefore AIA can be claimed. So capital allowances can be claimed on the van. So AIA would be claimed. So there'd be an addition of, it was 14,800. AIA, first year allowance, 100%. Well, it's not first year allowance, but 100% in the year of the addition. Now, of course, we know only 90% is for business purposes, because Harvey's got 10% personal use. So really important that you appreciate when you're looking at private use is only by the owner, only by the sole trader or partner themselves. If their employees use it privately, you don't need to restrict it for that when thinking about kind of capital allowances and or any deduction if it was a non-asset expenditure. Because think about it like that okay, they might be giving something to their employees for private use, but that's part of the employee's remuneration package, and therefore that is a cost to the business. Just like the Class 1 national insurance is a business cost. Giving your employees assets to use privately is a cost, just like paying their wages is a cost. It's only when you've got the owner themselves using it privately is when some of it isn't for business purposes. So therefore we would have the AIA there, so we'd need to deduct that. Now, of course, if we've used this method where we started with the net income, we know, of course, all of those amounts have been deducted, and therefore, there's a cost of a new asset there. If we started off here with the net income, that's deducted the whole amount of this asset. So therefore, we've got the van, the asset, it's in here at 14,800. You can't just deduct the whole amount of the asset as capital expenditure. So that would be disallowed, and instead, capital allowances would be claimed. Similarly, if there was like a depreciation charge in there, you disallow, and that's strictly what really should be in there from an accounting point of view. It shouldn't be just the cost of the asset in there. It should really be the depreciation charge. So you'd add back the depreciation charge and claim the capital allowances. But in this case, in his simple bookkeeping software that he's got, it's just got the full cost of the van there. So any amount relating to the tangible asset, disallow it, whether it's depreciation, loss or disposal, or in this case, even the whole asset itself. So capital expenditure, disallow it, and then we're going to claim capital allowances and thinking about, which pool would it go into? Of course, if it's a van, it would have gone into the main pool, and it has, it's gone into the main pool here, but we've claimed AIA on it in full. So, it isn't like cars, where it's all based on the CO2 emissions. You need to think which pool it's going to into, and you can't claim AIA. It's a van, so it's in the main pool, and AIA can be claimed. Just had to restrict it there because it's a private use asset. And also, even though we only bought it a few months before the year end, you still get a full amount of allowances. So it isn't like depreciation from an accounting point of view, when you prorate the depreciation from the date it became in use. For capital allowances, even if you buy the asset on the last day of the year, you still get a full year's worth of allowances, and you can still claim the full amount of the AIA. The only time you prorate these is if it's a long or short period of account. But we're told what the amounts were, for the tax year. So presumably, his basis period his accounting period is for the tax year, and he's been in business several years as well, but this is all for that full year. So we're not dealing with a long period of account here or a short period of account. So a bit fiddly there with the car, but there's easy mark with the van, sorry, but there's easy marks, medium marks, and hard marks. So not too difficult, but yeah, a bit fiddly there, and had to really think about that private use. But again, when you practice several questions, you see this come up time and time again. So then we've got transfer into his personal pension. So this time the other type of pension. So this is his personal pension. So as well as having a workplace pension run by the employer who manages the pension, so the HEL pension, as we had earlier, he's also set up his own personal pension. So, maybe it's like Hargreaves Lansdowne or, Standard Life, somebody like that. He's set up his own personal pension and has contributed 4,000 to the pension. So again, there's no talk about employer contributing to his personal pension here. It's just him contributing to the pension. So again, when you think, how does the individual get relief for it? So of course, we said with the employer pension, it was just deducted from the employment income. Quite easy in a way, deduct it from there, then they're going to save tax at their highest rate. So of course, anybody can have a personal pension, not just employees. They might not even have employment income. It might be like an unincorporated business. It might even be someone who has other types of income. They don't even have employment income and trading income, although those are the two types of income you can contribute to a pension, although there is a minimum amount that everybody can contribute to a pension. So therefore, for personal pensions, because anybody can set up a personal pension, you can't just deduct it from a particular type of income because they might not have that type of income. So the way it works here is that firstly, that the contribution is paid net, but a gross amount goes into the pension fund. And then also, if they're a higher rate taxpayer, the bands are extended. So we're told here that he makes a pension contribution of 4,000. So if you think about how this works, so obviously Harvey's income has been taxed. This amount is deemed to be made, after tax. So of course, this is paid out of, Harvey's pocket after he's already paid tax on all of his different types of income. So therefore, if he pays 4,000, that's a net amount. And what goes into the pension fund, so the first way he gets tax relief is the gross amount. So what we mean by gross is, before tax. So gross, minus, just like in general terms, like gross profit, net profit, isn't it? The gross is the full amount, and then minus off any expenses to get to like the net amount. So if you're thinking about this in the context of tax, gross is the before tax amount, that's the tax expense, then the net amount. So the contribution is deemed to be made net of basic rate tax, currently 20%. So he's made a contribution out of his net income, his after-tax income, so assuming 20% tax. And therefore, the gross amount of the contribution, doing this a long way around, is this. So if he's made a contribution of this, if we're assuming that he's making a contribution out of an amount which tax of 20% has been paid, then we can see that's the gross amount of the pension contribution. Now, if you kind of simplify these numbers down, of course, you can see that what we're doing here is we're taking this, and as we did there, divide by 80 times by 100, which is, of course, 1.25. So, of course, a simpler way to do this would be to just take the net amount and multiply it by 1.25 to get to the gross amount. So that could be a quicker way you can do that in the exam. Take the net amount, multiply it by 1.25. So this is the amount which goes into his pension, the 5,000. So that's how he gets some tax relief at the basic rate. But of course, if he's a higher rate taxpayer, then he needs to be given tax relief for the additional amount as well. Because of course, when you do it to a workplace pension, you deduct it from the employment income, so it's saving tax at your highest tax rate. This is just giving tax relief at 20%. So what we also do is extend the basic rate band. So we've got the basic rate band, whatever the basic rate band is, relevant to your exam. And then we increase it. So what this will do is it will mean that more of his income, which would have been taxed at 40%, is now going to be taxed at 20%. So we take the gross amount of the pension contribution and then we take the gross amount of the pension contribution and increase the basic rate band by that amount. So he's now got a revised basic rate band. And what this will do will mean that more of his income is taxed at 20%. And of course, if he was an additional rate taxpayer, then you'd extend the higher rate band as well. So when it's a workplace pension, you just deduct it from the employment income, nice and easy. If it's a personal pension, then what you need to do is gross up the bands. You don't really need to worry too much about what I explained about how he makes a contribution to this, but this amount goes into his pension. I think that's useful to understand how they get the basic rate tax relief. But then what we're going to need to do in the tax exams is extend the basic rate band and also, the higher rate band as well. So you'd extend the higher rate band as well, by the same amount. So then they end up saving tax at their top rate of tax. I mean, everyone has their basic rate and higher rate bands extended, but of course you only benefit from that if you are a higher rate or additional rate taxpayer. So very important that, you understand how the two different types of pension work. So of course, this isn't deducted when calculating the trading income. And of course, if you started with the net income amount, then it has been included. So therefore, you'd have the pension contribution, the personal pension contribution that had been deducted there. That shouldn't have been or shouldn't be deducted from trading income, because for a personal pension contribution, the way the individual gets relief is by grossing up the bands. Quickest way, take the net income, multiply by 1.25, that's the gross amount, add that onto the basic rate band. The other bits I explained, but just for your kind of overall understanding of the topic, which is of course really good to have. So then we've got some more information about the property. So we've got the estate agent fee. So again, we've got the property income. It's quite a similar principle in terms of kind of what can be deducted. Does it relate to the property income? Provided it's not kind of capital in nature, then it can be deducted. So definitely, like, the estate agent fee can be deducted, which is 10% of the rent, which you can see that there, the rent collected in the period. And we're using a cash basis here. So then we've got the replacement fridge. So we've got a note here. So it's the same as the one it replaced. So it isn't an enhancement. If you do have an enhancement, then all you can deduct is the amount for an equivalent replacement item. So, maybe the old fridge broke down, or they just needed a new fridge, but they've got the same model as the old one, and therefore it clearly is just a replacement. So that can be deducted. And then we've got the mortgage payment, which is 6, is an interest-only mortgage. So there's interest. So usually with a mortgage payment, usually you borrow money to buy the property, but then when you repay the mortgage, you're paying back the balance on the loan and the interest, so the capital amount, i.e. the balance on the loan and the interest. But this is an interest-only mortgage, so all of this is interest. So if you've got a mortgage payment, make sure you only pick up the interest amount, because you only get relief for the interest, not paying back the balance on the loan. So the interest, but that isn't deducted here when calculating the property income. There's specific rules for interest, and that is actually deducted after we've calculated the tax liability for the year. So that'll be deducted here. Some very particular rules around interest. I'd probably just put that here for now, and we'll think about how that works. But rather than being able to just deduct it from the property income and therefore save tax at the individual's highest rate of tax, what happens is everybody gets relief at 20%. So therefore, higher rate and additional rate taxpayers don't get additional benefit, because if you think about it, if you're a higher rate or additional taxpayer, then every expense that you get to deduct is saving you tax at your highest rate of tax. So if your basic rate, every expense saves you tax at 20%. If your basic rate, if your higher rate, every expense saves you tax at 40%, and if you're additional, then obviously at 45 based on current rates. So of course, an individual who pays rate tax at higher rates is obviously saving more on each pound of expenditure than somebody at the basic rate. And there are a lot of property investors having highly leveraged properties, saving tax at very high rates. And therefore, the government said that from now on, everybody saves tax at the basic rate, so at 20%. So rather than being able to deduct it from the property income, they instead just deduct it at 20% from here. Now, sometimes it can be, so it's offset against the actual tax liability. Now, in most cases, it's 20% of the interest, but if the property income is lower than the interest, or total taxable income is lower than the interest, then that would reduce it as well. But of course, we know the property income is higher than the interest. That's higher than the 8,000. And of course, we know their total income is going to be higher than that as well. So the interest deduction is going to be this specific, very specific rule there. So that was it. That was all the information from his cloud-based accounting software. So we know there was nothing else to go into the trading income. So as I said, you could start with the net income figure that we were given here, and then take out the non-taxable income and disallow the disallowable expenditure to get down to the total income there. I think we didn't, of course, that would have included the mortgage interest as well. In fact, that would have included a few amounts for the property. So all of this property amount, that all, of course, all went under property income. So we've got we're going to have a few of these amounts in here because we disallowed all of the expenditure which didn't relate to trading income. So we've got the estate agent fee. So this way actually worked out, a lot longer, because most of the amounts didn't actually relate to trading. So 1820, then the 686 and the 8,000, because that all, of course, came under the property income. And then as an alternative, so rather than starting with like the overall profit, taking out the non-taxable income, disallowing all the expenditure which isn't trading related, you could, of course, just start with the income which is trading and then just deduct all the amounts which are allowable. But of course, you'll get to the same answer, just two different ways of doing the same calculation. But it is important to understand both, as I explained before, some questions will give you a draft profit number and tell you that. So it'll give you a number like this and say, the following amounts have been included, and therefore you need to take out amounts which aren't taxable and add back expenses which are disallowable or fall under a different area, under a different schedule, like property or interest or dividends or wherever. So you start off with the net income, take out the non-taxable income or amounts taxable elsewhere, add back the disallowable expenditure or amounts deductible elsewhere to get to the trading income. Or sometimes they tell you, this is before including the following amounts, and therefore you'd include any taxable income and then include any allowable expenses. But it's just two sides of the same coin. So then we've got the trading income. Just make sure that we've dealt with all of the notes. That's why I like to cross them off as I go through. We're told Harvey has an unused trading loss brought forward of £2,000 from the previous tax year. So he must have made a loss in the previous year. Maybe the salon didn't do very well, or maybe he had some capital expenditure and could claim a lot of capital allowances. We don't know exactly why he had a loss, and it doesn't really matter too much. Maybe he started with an accounting loss, or maybe he, as I said, he had a lot of capital allowances to claim. It doesn't really matter either way. He ended up with a loss. And of course, as we covered in the trading losses class, we know trading loss will be carried forward against trading income unless there had been a claim to use it in the current year, or possibly carry it back as well. But we're told he carried the loss forward, and therefore it would be offset against trading income. So therefore we could show that being offset there against the trading income. So of course it would apply to however we've calculated it. So we've got that there, which is offset against the trading income. So therefore we've got the trading income for the year. So that's the final amounts that we needed there for the trading income. So we then have the property income, which we calculated, of course, not including the interest expense, which is a tax reducer. So then we can see the total income for the year. The dividends, of course, were exempt, and we've got 105,000 there for the total income. And then we can deduct the personal allowance. So we've got our total non-savings income, small amount of savings income, which of course gets us to the total. Probably just want to sense check those numbers, but that was right for the employment, trading, the property. They all seem sensible based on the numbers that we had. So of course we know that personal allowance would then be deducted, but of course when income goes over 100,000, then the personal allowance will of course be tapered away, and we can see this individual has got income more than 100,000. So we're starting to think that that personal allowance is going to be tapered away because they've got their personal allowance for the year. But of course, income, when we're looking at it, we're thinking, well, that's 105k. They've gone 5k over the 100,000, and therefore they're going to lose 2,500 of their personal allowance. However, remember that when you do this test to say, is income over 100,000, you of course deduct any personal pension contributions. So you might think, why didn't you deduct contributions to the workplace pension? Well, of course, those have already been included with reduced employment income. So therefore, this income is already reduced for those pension contributions. The contributions that he made to his workplace pension, they've already been included because they were deducted here. So that's already reduced the income. So of course, it's unfair, if you like, that his personal pension contributions haven't also been included. So therefore, that's why we include those as well. We include the gross amount, and therefore that reduces his adjusted net income for the purposes of saying, is it more than 100,000? Well, of course, no, it's not. It's exactly 100,000. So whether that's coincidence or whether he's been advised, by a very good accountant who said, make a personal pension contribution and that will prevent you losing your personal allowance. So now we say to ourselves, is his income over 100,000 once we've deducted the gross personal pension contributions? And gift aid, of course, works in the same way. He has personal pension contributions in terms of grossing up the band and then also doing the personal allowance test. So we say, is it over 100K? Well, the answer is no, it is 100K, and therefore he still gets his full personal allowance. So it looks as though there's been some quite clever tax planning there. So you can see we're making pension contributions. Not only do you get to contribute the income or the money to your pension tax-free because you've deducted it from your employment income, so meaning that you don't pay any tax on it, or you gross up the bands and save tax at your highest rate that way. You're saving tax at your highest rate, but you also can save your personal allowance as well if you are going to be losing it. So therefore, incredibly generous tax relief available on pensions, hence why the government always seems to be looking at potentially reviewing it and obviously making it less favourable, but at the same time they want to encourage people to save for their retirement, so they're not relying too much on the state. So then we can see full personal allowance. So this would be the amount subject to tax. We've got the non-savings income. So of course we know the basic rate band is this amount. So we've got the revised basic rate band here, and that will be the first tranche of tax, and then we can see we would have the next amount is going to be here at 40%. So of course, make sure you just get your basic rate bands and your higher rate bands from your open book in the exam. And then you can just make sure that you have taxed all of the income. So you tax all of the non-savings income. And then of course, because the individual is a higher rate taxpayer, they'll have a savings allowance in this tax year of £500. So of course, we know that's all going to come under the personal savings allowance. So we could just put personal savings allowance there. You know, we know it's at, of course, 0%. And therefore we could work out the total income tax liability for the year. So we've got the tax liability there. And then we've got the income tax reducer, the interest on the mortgage. Of course, we didn't get to deduct it here. If they'd been able to deduct it here, they would have saved tax at 40% because they're a higher rate taxpayer. But it's capped at 20%, so everybody saves tax at the same amount in theory. So therefore, we get to deduct that. So that would get us to the tax liability for the year. And this amount of tax has already been paid. So we've had some tax which has already been paid via PAYE. And therefore, this is the amount of tax which is still outstanding for the year, which is the tax on the trading income and the property income, because there's nobody withholding that tax, there's nobody deducting that tax, and the tenant just, you know, pays the rent to the landlord, to Harvey in this case. The customs at the salon, you know, they just pay, you know, Harvey. So nobody's withholding the tax, unlike with an employer-employee relationship. The employer pays the employee but withholds the tax and pays that over to HMRC. So the tax on the employment income has already been paid, but the other tax hasn't been paid, and that'll be paid via self-assessment. And to, you know the exact amount that would need to be paid, we need to know what payments on account had already been made for this tax year. And then, of course, we could advise on what the payment account would be for the next tax year. We need to know the class 4 national insurance due as well, and we could work that out here. It's class 4 national insurance, but we're not asked to in the question. The question is just asking us here to calculate the income tax payable, so there wouldn't be any marks for that there. So quite an evolved question, because there were so many different types of income. There was the employment income, the trading income, the property income. Then we had issues with the personal allowance. We had the pension contributions as well. So there was kind of quite a lot to deal with. But once you've done that, you can copy your workings. And I always suggest copy everything over. I mean, some of that was for tutorial purposes, but you can copy everything over into your word processing area for marking. It always copies over quite nicely in the exam, certainly better than it does there in Word and Excel. So the next part of the question was regarding Harvey's future plans. So regarding his future plans, firstly, calculate his net disposable income. So this is a very popular question in the TC exam, and it requires you to, in a way, not just think about tax. So somebody's net disposable income. So we need to think about all of their income that they're going to get, minus all of their expenses, is going to give them their net income. So quite often in these questions, the examiners don't just give us tax amounts. So it isn't just calculate the tax liability. They want their net disposable income. They're going to know their different income sources, minus their different expenses. And yes, one of those expenses will be income tax, and one of those expenses will be national insurance. But the whole question isn't calculate the income tax and national insurance liability. And that's where students drop a lot of marks, and they drop a lot of easy marks as well. So as usual, it's best demonstrated by looking at a question. So we're told, as part of his semi-retirement plan, on the 5th of April 2024, Harvey will sell his hair salon and Hilling Road. So he's going to sell his business and his investment property so that he can pay off the mortgage on his home. He will continue to work 2 days per week at HEL until he can start drawing income from his pension. So he's going to semi-retire, he's going to sell his business, and he's going to sell his investment property so that he can pay off the mortgage on his home. So it sounds as though he's no longer going to have this trading income and his property income. He's going to sell the businesses, use that money to pay off the mortgage on his home. And he's going to continue to work, though, 2 days per week. So he'll still have this employment income, continue to work 2 days per week until he can start taking the money from his pension. So then he would start taking the money from his pension, 25% tax-free, and then the rest taken as income would be taxed as non-savings income. So Harvey needs to know if his income from HEL, so his employment, will be enough to cover his living expenses of 20,000. So that's why he wants to know what his net disposable income would be. He knows he's got expenses of 20,000. Is it going to be enough? So his only type of income is now going to be employment income, and he wants to know what his net disposable income would be. So let's just kind of step back and don't just think about this from a tax point of view. What's his income going to be? Well, of course, his main amount that he's going to get paid from that job is his salary. If we just think back, what exactly was it he had? Well, he had salary of this amount. So that's like the regular cash, of course, that his employer pays him. So, for the full year, he's going to have his salary of this. So does he, have any other, cash amounts? Well, he gets that lump sum, doesn't he? So we were told that he also receives, from his employment, we were told it's a general lump sum, but he spends some money on entertaining. So if we assume the same amount continues, then yes, he'll kind of have a lump sum. So his employer gives him an extra 250, but he will have an expense. Now, we'll probably just assume it's going to continue at the same amount. I don't think we can really assume anything else unless we were told otherwise. So assume that rates and allowances, continue to apply. So I think it's kind of saying just assume that things will continue as they are. So, he'll get his salaries of this, he'll get that lump sum amount, but he'll actually pay some out entertaining. Now, of course, when we did the tax calculation, you can see we only included this, but we're calculating the tax, saying how much tax is due on that. These aren't all cash amounts. Salary is a cash amount. The lump sum, the cash amount's really the net of the two. None of these are income, using the asset or, the car. That's not kind of cash coming in that will affect his tax liability. So that's the income that he's going to have coming in. What expenses will he have? Well, we said he pays that entertaining expense, the contribution to the car. That was a capital contribution, so we don't think there'll be any more capital contributions. Doesn't pay anything towards the asset. It makes his employee contribution still, so we'll assume that would continue. So he's going to have cash going out of this. So even rather than calling it income and expense, it might even be better to think of it as, cash in, cash out. So he's got the pension that he's going to be paying out. That's his contribution to his pension, so building up his pension for when he does retire. And of course, what else is he going to have coming out? So his employer, pays him his salary, pays him the lump sum. He pays out his pension contribution, pays out money on the entertaining. Of course, he also pays out income tax and national insurance. We need to know what those are. So, I said, these are an important part of the question, but they're not like the only part of it. Look at those other easy numbers that we got there, just for thinking about what exactly are we being asked here. So how will the income tax and the national insurance work? Well, in fact, we've already worked out the income tax, haven't we? Because we know the total amount he receives from his employment. We've already got his employment income. So we know that this is the amount that's taxable. So for income tax, and again, this is what's worth thinking about in terms of cash and benefits, because we know, so the amount which is taxable for income tax is the cash and the benefits. So it's a total amount. From his employer, he receives cash of this, taxable benefits of this, and that's what's subject to income tax. It's the cash and the benefits received from the employer. So these are the amounts which are subject to income tax. But for national insurance, employees' national insurance is just the cash they receive from the employer, not the benefits. I said earlier that's very important. It's important you appreciate that the employee does not pay national insurance on benefits. So what are the cash amounts? Well, we know that he receives, so it's going to be the salary and the lump sum. We kind of already picked those out earlier. And that's why when there's a national insurance question after the income tax bit, that's why I sometimes separate, or I like to separate the cash elements of the remuneration and the benefits amount, because I know national insurance is only on this. So it's income tax and national insurance on the cash, but only income tax on the benefits, no national insurance. The employer, as I said earlier, does pay national insurance on the cash, class 1 secondary, and the benefits as well, class 1A. But look, no employees' national insurance on the benefits. So we know that the amount subject to income tax, so it'll be the cash and the benefit, so this amount, and then national insurance, it will just be the cash. So we know we've got the personal allowance, you've got the personal allowance for income tax, and then the lower earnings limit for national insurance, which are now aligned for this tax year, so 23, 24. So we've got the taxable minus the personal allowance, and then we've got the amounts which will be subject to tax. Now we know that income tax, that's all going to fall within the basic rate band, so that's all going to be at 20%, and then the national insurance is going to be at 12%. So you've got the personal allowance and the 0% band for national insurance. These are the amounts which will be taxable. Obviously, only the cash which is subject to national insurance. Income tax 20%. It's all in the basic rate band, and then it's all in the 12% band for national insurance. Of course, if you went into the higher rate band, income tax jumps to 40, but national insurance falls to 2. So really, at the moment, his tax is total tax is 32%. Once he got into the higher rate band, it would obviously be 40 and 2. The national insurance drops at exactly the same point. Income tax would increase to 40%. So really, think of the tax rates as more like 32 and 42%. So that would be some of his expenses. He's going to have to pay our income tax of this, national insurance of this, and then this will get him down to his net income, and it does look like he's got enough to pay his bills. I mean, you could even put those in there as well, living costs, and then you could just say, so if we include that in there, clearly that's just going to leave him with about 1,600 left over. You could even put, just enough. So that's why somebody would want to know that. Think about a client coming to you. They don't just want to know what the tax liability is. They want to know, how much money am I going to be left with? I'm going to earn this income from my job. This is my remuneration package. My employer is going to give me this, this, and this. But what they want to know is, how much am I going to be left with in my pocket so I can pay my bills, to see whether this job gives them enough income. So you think about the cash coming in, and then you think about the cash going out, so their expenses. Income tax and national insurance is just an expense, but they've also got their other expenses as well, like their living costs, and pension contributions, and any other amounts, your holiday, for example, whatever else you're told in the question. But you can see these amounts were all just easy. Just as long as you thought along the lines of cash in and cash out, it was quite easy to get those ones. And then just appreciate income tax and national insurance are just an expense. So therefore, those can be deducted, should be deducted there. And then we would just go through and do that calculation that we've done there. And of course, when we, in the net disposable income class and after tax cost class, we looked at some cases where we had like a business owner paying some money out, and then we were working out what would the after tax cost be. They're paying money out, they get a tax saving because they can deduct it from their trading income and for class 4 NI purposes. And therefore we get to the net cost, which is lower than the actual amount of the cost. And we saw some questions there as well. So that's very similar to this question here. So that was the 6 marks there. And as we said, some of those were very easy. These marks were very easy. And then those two there, just a bit more involved, not too difficult. So calculate and explain Harvey's marginal tax rate, assuming any additional income is from employment. So what's his marginal tax rate? So what this means is the tax rate that he would pay on any additional income. So on the next pound of income. So if he earns a little bit more income, what tax would he pay? So it said calculate and explain his marginal rate of tax. So his marginal tax rate, and it said as well, assuming that any other income is employment income. So if he earns some additional employment income, and assuming it's cash as well, we could possibly even clarify that. But assuming it is cash, then it would still be in a basic rate band. So 20% income tax, 12% national insurance, 32%. Quite straightforward there. But we need to explain it as well. So you could say, Harvey's marginal tax rate on employment income, and you could put in brackets cash, is 32% made up of 20% income tax and 2% NI. So that's kind of quite straightforward there. And we just specify them. I mean, you could possibly say that if it was a benefit, then it wouldn't be subject to NI, but that would be fine there. It's only 2 marks there. So they'd want the marginal tax rate and they'd want you to clarify what it would be on. So then we also had to deal, so we had to calculate and explain Harvey's effective tax rate on his employment income. So what's his effective tax rate? So what effective tax rate is saying is, what rate of tax is Harvey paying at? And you might think, well, he's paying tax at 32%, but is he? Because this is his employment income. Yeah, if we think about purely just on tax now, this is his employment income. Some of it's being taxed at 0%, and then some of it's at 20%. So actually, his overall, tax on that income is lower than that. If you just looked at the tax, you'd say, well, this is the amount of tax he pays on this amount of income, and you can see it's lower than that because some of it's being taxed at 0%, personal allowance, and some of it's being taxed at 20%. So if you kind of did it overall, so you've kind of got his overall tax here, and you say, okay, this is the tax and national insurance he's paying on employment income of this, this is his overall tax there, so like 19%. So we would say here that effective tax rate is and you could almost say it's like the average tax paid on employment income. And you can say this is, and we've worked it out here, this is 19%. And the examiner will see once we copy our workings over how we have worked that out, and you could even just put that there. You could have the tax and then the employment income. I mean, there would be other ways you could do it. I mean, strictly speaking, you could say the employer pension contribution, his pension contribution is income, and therefore that include it there. So you could probably do a more accurate working, or you do a different working in other circumstances. But for 2 marks in the TC exam, then the examiners appear to be happy with you just taking the overall tax liability divided by the income, a very kind of approximate method of calculating the effective tax rate. But that's like the overall tax they're paying. So taking the tax, divided it by the taxable income. And of course, the reason that's lower than like the headline rate is because some of it was at 0%. It's effectively like a weighted average. I mean, you could even do it, the weighted average calculation, or a very long way around of doing it, but to prove it to yourself, you know, some of it's at 0% and some of it's at 32%. So it kind of makes sense that we've come out at 19 because of, you know, 40K of income. We've got this amount at 12.5, and then the rest at 32. Although actually the benefits aren't subject to national insurance. So some of it's at 20 and some of it's at 32. But yeah, that weighted average kind of makes sense there. So that'd be enough to pick up those marks there, the average tax paid on employment income, and then giving the number as well. So I just wanted to be brief there for 2 marks. Could have added a few more points as well if you wanted to, but that would be sufficient there. 2 points to pick up the 2 marks, and 2 points there to pick up the 2 marks there. So this was like a longer income tax question, a really good question. One big scenario, but you've got the employment income, the trading income, the property income, and then one of those net disposable income calculations as well. And we saw kind of all of the main topics really there in income tax. I guess we didn't really touch on the international aspects much, but we saw like employment income, we saw trading income, we saw property income, interest, dividends, pensions, a little bit on losses, not as much there on losses, but the personal allowance tapering, the different bands, PAYE. Like I said, we didn't see as much on the international aspects, but of course we've got an international income tax class where you can go back and watch that again. We saw the trading income, didn't see much on a cash basis, but again, we've covered that in a cash basis class as well. So touched a little bit on losses, more on that there, more on pensions in the pensions class, as I said there, with the international aspects. So if ever there's any areas that you're not as clear on, as we've done in the previous classes, you can go and focus on those individual areas like employment income. You can go through several questions and practice them one after the other to test yourself on that knowledge, or trading income, go through all the recent exams, just practicing that calculation of trading income, really testing yourself. Do you know which amounts are allowable and which amounts are taxable and at which rates? But that was a really good question to bring it through, all together. And of course, there are other questions in the question bank which require you to do the full income tax computation, your full income tax liability or income tax payable. So make sure that you go away and practice, several of those as well, where we're just really kind of bringing it together. In earlier parts of the course, we focused just on employment income, then another class focusing just on trading, another class focusing just on property, another class focusing on pensions. But these full income tax computation questions, they bring it all together. So they're really good to kind of just test you on all of the different bits and bringing it all together. So once you've mastered all of the individual areas, these are really good questions to go away and do.